Unconventional monetary policy in the U.S. Most people here probably already know the overarching goal of unconventional policy in the U.S. was to try to lower long-term interest rates, private sector interest rates, increase the availability of intermediate credit, and the unconventional policy consisted of really two prongs, as I'm sure you know. The first prong was something I'm calling quantitative easing. When you talk about quantitative easing, we're talking about 3 asset purchase programs, the LSAPs plus the maturity extension program, or MEP. So my chart here shows, you've probably all seen some version of this chart at some point. This shows the central bank, the Fed's balance sheet. And the thing that I want to bring out from this chart is that the 4 different policies were rather heterogeneous in their nature. So LSAP 1 and LSAP 3, you see on the chart, involved large increases in the volume of mortgage-backed securities held by the Fed, which is a very novel policy. LSAP 2, or I should say the maturity extension program in particular, involved a very major substitution from short and intermediate term bonds to longer term bonds. So, and then the second prong of unconventional policy was forward guidance. Forward guidance, of course, consisted of statements intended to reduce expectations of long-term interest rates, of short-term interest rates, and by doing so, decrease long-term interest rates. Now, it's worth pointing out that the Fed had already been engaging in some kind of a weak form of forward guidance for some years. So, for example, forward guidance was a statement from 2006 stated that the committee judges that some further policy firming may be needed to keep the risks of inflation and output on track, in balance. Well, the forward guidance policy was kind of in the same spirit, but just more concrete in terms of what it said about future interest rates. So, for example, the December 18 statement, 2008, spoke of keeping the funds rate low for some time. They got a little bit bolder in 2009, referring to a low period of very low interest rates for an extended period. Beginning in 2011, they went to calendar-based statements, such as exceptionally low levels of interest rate for at least through mid-2013. And then in 2012, they went to a very explicit statements about the level of interest rates contingent on economic conditions, so at least as long as the unemployment rate remains above 6.5%. So let me just take a moment to mention what unconventional policy was not. When I talk about unconventional policy, I'm going to exclude things like the alphabet soup of various emergency lending programs, commercial paper funding facility, TAF, and all that stuff. I've lost track of all the abbreviations. And it's also quite different from the quantitative easing policy practiced by the Bank of Japan. To recall the difference between what the Fed was doing, what the Bank of Japan was doing. The Bank of Japan was focused primarily on bank reserves, which they like to call current account balances confusingly, whereas the Federal Reserve was really focused more on the asset side of the balance sheet, emphasizing the quantities and the nature, the characteristics of the assets being purchased. So did it work? That's the central question here today. Did unconventional policy stimulate spending and speed the recovery? It's actually not an easy question to answer, which is, I guess, partly the reason why we're here. So the fundamental problem in assessing the impact of unconventional policy, indeed any kind of a policy, is that we really don't observe anything you might think of as a controlled experiment. So therefore, it's hard to identify a causal effect of these policies. So a skeptic would say, well, gee, interest rates fell after quantitative easing and forward guidance, but maybe they would have fallen anyway, given the weak economy. Or the skeptic might say the economy continued to contract despite quantitative easing and forward guidance. Therefore, the policies were ineffective. Or might even say the economy eventually recovered, but maybe would have done so on its own, even in the absence of these policies. So the trick in terms of identifying the policies is to find some kind of a sort of an exogenous movement of the policy one might use to identify some causal effect, which is very difficult. Some additional complications arise in the context of unconventional policy. Well, first, there's the relatively short track record, about 7 years all told, which really is not even a full business cycle. In comparison, when economists look at the impact of conventional policy, they're drawing on a 4 or 5 decade experience with interest rate policy, and even then, there's still some debate and some uncertainty about the effects of conventional interest rate policy. Second, the quantitative easing, at least, relied on kind of a poorly understood, maybe that's too strong a word, or maybe an under-researched transmission mechanism, namely the portfolio balance effects, which I think were sort of abandoned as a thing research-wise back in the 1970s, and then they came back into vogue, sort of, and the Fed and other researchers kind of had to reinvent or rediscover that aspect of the transmission mechanism. Third, as mentioned previously, the policies were rather heterogeneous in terms of the asset mix being purchased, the type of assets, and of course, forward guidance, nothing like that had really ever happened before. And so it became a challenge for researchers to really come up with a summary measure of the stance of monetary policy, so to speak, that one could then assess the impact of. And then finally, of course, lots of other things were happening at the same time. Of course, lots of other things are always happening at the same time, but this particularly acute in this point. Economists are always, in order to assess the impacts of any policy, economists are typically looking at how deviations of policy from the normal course of policy would move, or shocks, as in the jargon, would move the economy away from its normal trajectory. Well, things were so different in 2008 that it's really hard to know what normal would have been in that context, and hence hard to know exactly what a shock to monetary policy would have been. Well, so having explained why discerning unconventional policies effects is so difficult, I'll move on to a very brief summary of some of the research that's out there. As Don mentioned, there's been a ton of work and countless papers, more being written every day, so already my survey is going to be a little bit out of date. But I think it's useful to start with something of a taxonomy about the kinds of research that's been done on the topic. So in one bin, I have put the studies that look at the impact on interest rates. And so this is relatively straightforward to do, although there are some issues. And there are two kinds of studies that fall into that bin. One are what I call event studies, and the other is what I call econometric term structure models. Another bin of research is studies that look at the effects on the real economy. This is a little bit trickier, or a lot trickier. And there are two types of research in this category. One would be studies that are sort of macro level. They look at macro effects, typically using a macro and aggregate macro model. And then there's some interesting research using microdata, micro level studies on the differential impact across different firms or banks. So quickly, event studies, a quick summary of what these are and what they have found. The basic idea of an event study is quite straightforward, of course. You look at the market's response to the announcements on the day of, or maybe in a very narrow window around the announcement of around the policy. This, of course, relies on the policy being unanticipated, because if the policy were anticipated, those effects would have been priced into the yields, priced into the stock prices, whatever, and so you wouldn't see an effect even if the policy were actually having an effect on the economy. So what I've shown here in the pink bars are the change in the 10-year Treasury rate on various key announcement dates for quantitative easing. These are my calculations, but they're virtually identical to the ones that are out there in the literature. And as you can see, the first section of the chart shows the impact of the LSAP-1 announcements, and as you can see, four of the first 5 announcements resulted in very large negative impacts on the 10-year Treasury yield. In fact, if you add up all those effects, however many there are, you come up to about 100 basis points, a full percentage point reduction in the 10-year Treasury rate. But what one sees is the announcements associated with subsequent programs are somewhat smaller. Again, this may be because those programs are less effective in terms of lowering interest rates. Or it may simply be that those policies were more widely anticipated than the announcements associated with the first LSAP. And then another twist in terms of assessing the impact of the quantitative easing policies is that many of this, or at least a few of the quantitative easing announcements came on the same day, the same FOMC statements as key forward guidance announcements. So it becomes a little bit tricky to disentangle the effects of forward guidance versus quantitative easing. There have been efforts to do so, but I don't have time to summarize those. So a few other caveats having to do with event studies. One, some of the early LSAPs took place in times of market turbulence, and so some of the effects one sees from the first LSAP could have been a result of improving market functioning. Second, to the extent that the announcements were anticipated, as previously mentioned, the observed responses from the event studies would tend to understate their effects. But at the same time, I think there are real concerns about the event study evidence because they don't really tell us much about the persistence of the effects. Did they dissipate after a few days, after a couple of weeks? We really don't know for sure. And obviously, if they were less persistent, then that would have a smaller macroeconomic impact. Well, another approach involves what I'm calling economic term structure modeling, and okay, this is a pretty complicated but rigorous but rather opaque way of assessing the impact of changes in quantities on the asset prices and bond yields. Not enough time to go into that, but the bottom line is really trying to affect the impacts of the prices on the quantities on the prices, and in doing so, imposing some economic structure on the model and separating out the advantages. It separates out the expected interest rate effects from the term structure effects, which allows for the separate identification of those portfolio balance effects that I mentioned earlier. And the advantage relative to the event study evidence is it doesn't rely on the markets being surprised. These will work even if markets fully anticipate those announcements. Ballpark estimates for this kind of study come out to be about 40 to 50 basis points for the LSAPs and about 20 basis points for the maturity extension program. Pretty respectable reductions in the interest rate. Mostly, but not entirely, this came through reductions in the term premium with some marginal effect on expectations. And I have a nice chart here, which I don't have time to show because I'm running low on time. So we get to the really, I think the important question here is whether unconventional policy had any real effects. Measuring the effect on interest rates is relatively straightforward, a bit tricky, but this is much harder. One way to do it involves feeding the interest rate reductions that come out of these other models, particularly the term structure models, into a macro model and see what comes out in the other end. A couple of studies that do this have come up with an estimate in the range of about 1 percentage point on inflation, pretty respectable, with some lag. There's also a set of studies that use, very interesting studies that rely on microdata methods. The insight is that these policies would be expected to affect different firms or different banks differentially, depending on their characteristics, depending on their initial conditions. I'll just mention a couple of sets of studies. One found that firms with more reliance on long-term debt tended to respond more favorably, tend to be benefited from the maturity extension program, which recall was explicitly designed to reduce long-term interest rates relative to short-term interest rates, relative to those firms that relied more on short-term debt. Good circumstantial evidence in favor of the effects of maturity extension program. Another trio, I think, of studies at least looked at the bank's exposures to mortgage-backed securities and found that those with a greater exposure to mortgage-backed securities tended to benefit more from the first and third LSAPs, which, to recall, were primarily focused on purchases of mortgage-backed securities. The issue with these micro-based studies is they don't really tell you much about the aggregate effects. They're kind of strong circumstantial evidence that the policy has had an effect. It's hard to aggregate them up and say, okay, the bottom line effect on the macroeconomy was whatever. What about costs? What about the unintended consequences? Well, one, as Don mentioned, is inflation. I think we can really dismiss that out of hand without giving it a second thought. I think a more serious concern is that these policies resulted in adverse or disruptive spillovers to other economies, particularly to emerging markets. But a couple of points need to be made here. This is, one is that these are not unique to unconventional policy. These are true of any kind of any monetary policy, low interest rate, expansionary or contractionary. I haven't seen any evidence indicating that there's anything unusual about quantitative easing. And secondly, these effects are certainly preferable to a more protracted US recession, which would have been highly damaging to many other economies. A less easily dismissed concern is the concern about excessive risk-taking, and the difficulty here, I think, is defining what constitutes excessive. During a period of financial crisis, financial market disruption, we saw a lot of flight to quality with investors being very unwilling to take on any kind of a risk. And in that context, a little encouragement to take some additional risk might actually have had some positive effects, wouldn't be such a bad thing. In any case, this is an environment where a little bit of additional risk at a micro level, to the extent that it contributed to economic recovery, would have had a beneficial aggregate effect. So, should the Fed use unconventional policy next time? Well, to summarize, one part of the question is whether it worked. And I think the evidence is such that it will never really rise to the beyond a reasonable doubt level. That may be unrealistic to ask given the limitations of the studies and the short sample period. But I think by the preponderance evidence standards, the answer is clearly yes, at least to some extent. What about the costs? I haven't seen anything that would indicate the costs were major, although there is some legitimate concern about a too low for long environment. But I should point out that this is not specifically a function of unconventional policy, so much as it is a function of the Fed's interest rate decisions in recent years. So finally, bottom line, why not?
Thanks for watching. Be sure to like and subscribe for more videos from Brookings.